Take your seats, and without further ado, I'd like to welcome you to the keynote, The Disruptive Role of Technology in Capital Markets, where we will look at the impact that technology has played in shaping of modern-day capital markets. I am delighted to introduce you to Mr. Damian Bunce, Chief Customer Officer at Exness, who will share his incredible knowledge and insights. Damian, please welcome to the IFX Expo stage.
Hi everyone, can everyone hear me okay? Fairly small room. If this is the biggest FX event in Dubai, I'd hate to be at the smallest. Anyway, I've got about 20 minutes to give you a quick snapshot of 20 years of what technology has done in capital markets. I'm going to stick with it because it's 12:40 and I know all of you want to get to lunch afterwards. So, my speech is about the disruptive role of technology in capital markets, and I'm going to walk you through the FX, the crypto, and the equity markets, and draw parallels with what's going on between equities over the last 20 years and crypto. And on the whole, generally speaking, I'm targeting this for B2B customers, as it's a B2B event. Very briefly, who is Exness? Most of you know we are the largest retail broker in the world. We execute on average about $4 trillion per month, so as you can imagine, we're a huge business. We have roughly 650,000 active clients trading with us every month. And having dominated the retail space, we are now entering actively the B2B space. So if you are a small business owner, if you're running a medium-sized business and you want access to this huge pool of liquidity, then you can come to booth 1 or speak to Pete Plester, who's conscientiously sat at the front waiting to market to all of you. Okay, so technology has had a huge impact on capital markets. I think that would be obvious for anybody. I mean, not only can you access markets 24 hours a day, from your handheld and trade every asset class, the backside of capital markets, if you like, the market microstructure has changed phenomenally during that period of time. Over 100 years ago, trades were conducted on exchange in what's known as an open outcry scenario. And it's where trades are conducted basically using hand signals. So our global capital markets for over 100 years were controlled by traders in the pit, basically communicating buy and sell signals using their hands. Obviously, that doesn't scale particularly well unless you have 1 million people with hand signals. That moved into the big bank regime, okay? So the Goldman Sachs, the JP Morgans, the Citigroup, all of these guys began to control the liquidity all the way through from the late 1980s right the way through to some extent about 2010, and Nick, who sat in the audience, who worked with me, will remember that period of time. And today, where we are right now, my presentation will give some detail on this, is liquidity in our capital markets today, whether it's equities or FX or crypto, is controlled by very powerful, very large private companies. And it's all done extremely high tech, not on exchange anymore. This is an iconic picture. This is the New York Stock Exchange, an icon of capital markets. In fact, this picture on the left-hand side was taken in 1941, which is the day after Pearl Harbor, so it was going to be a busy day for markets anyway. But suffice to say, at one point in time, the New York Stock Exchange employed 5,000 people, and here's a photograph of it today. Less than 200 people powering capital markets because obviously computers have come in and taken that role. So let me quickly give you a high-level summary of what capital markets look like. Some of you in this room will know this. For those that don't, when we think about capital markets, it is not one big centralized liquidity source anywhere. Capital markets are highly fragmented and dispersed all around the world. So if we look at the global FX market, FX by nature is a capital commitment business, okay, which means you need money in order to do business with somebody else. And FX liquidity is dispersed all over the world by different venues. Over the last decade, the big global exchanges, like the CME Group, like the London Stock Exchange and the CBOE, have purchased liquidity sources and become big sources of FX liquidity. But it's also still the big investment banks and increasingly the very large independent market makers such as Citadel, Jump Trading, and XTX, etc. So these are the people that primarily dominate in the FX market. Suffice to say, FX is highly distributed. Similarly, if you look at the global cryptocurrency market, obviously this is a much smaller market. So FX on the whole is trading roughly $7 trillion per day, whereas the global crypto market is something like $150 billion per day. So it's a fraction of the size of the FX market. But suffice to say, the same problem exists, and that is that liquidity is still dispersed. Now today, the bulk of that liquidity resides with Binance. In spite of some of the SEC probes, etc., Binance continues to execute the bulk of both the spot and the derivatives liquidity. But you can see firms like OKX, Coinbase, Bitforex, and others are increasingly gaining liquidity. My point being here, and all I need you to understand in the minute that we have on this section, is that liquidity in capital markets, in crypto, and in FX is highly dispersed and not controlled by anyone. And if we look at the global equities markets, again, the global equities markets, again, highly dispersed. What used to be centered, for example, in the New York Stock Exchange is now operating across 60 exchanges. So when you look at global equities, liquidity is organized between what's called recognized investment exchanges, so things like the New York Stock Exchange, the London Stock Exchange, Deutsche Börse, Euronext, Tokyo Stock Exchange, etc. So recognized investment exchanges. What's called multilateral trading facilities. These are also locations for liquidity, as well as what's called dark pools and systematic internalizers. So my point being that when you think about global capital markets, it's highly dispersed, and how do you access these markets? Well, as traders, we've all become used to this view. This is a typical trading screen. So when you think about all that mishmash of liquidity behind scenes that I've shown you, technology like this pieces it all together and makes it accessible for traders. So we have an order book. All of you will know what an order book is. And on the order book, we have offers and we have bids. These are prices that you can sell to the market, or the price the market's prepared to buy from you. Okay, we have the volumes. In this case, I'm looking at crypto here, so that's fractional, but it's the amount of a certain asset you can buy. So you have bids and offers and volumes, and you have what's referred to as a touch price. So this is the best bid and offer. And in the example I'm using here, you can buy 1.19 Bitcoins at the price of 28,000. So given Bitcoin price today, obviously this slide was prepared a little while ago. And we also have something called the top of book, or the touch price. And this is where most of the trading is conducted. And if you were to look behind those prices today, in today's markets right now, the names that you would see is not Fred Smith, or it's not Capital Group buying from Fidelity. It's market makers that stand in between those institutions. And so you'll see companies like Citadel and XTX operating on both the bid and the offer at different depths. So what I'm hoping to show you here is that liquidity is dispersed and it's pulled together by front ends, very common trading front ends, and a host of very large liquidity providers making markets for us. So I'm going to tell you a small story now in the 10 minutes I have left and give you an example of what happened in the equities markets in Europe, in particular in the UK market. And I'm going to tell that story because it paints a very clear picture, at least in my mind, of what the crypto community is going to go through over the next 10 years. You know, equity, unlike FX, has limited supply, okay? And if you are a large institutional client and you want to buy 10 million shares of a company, you're going to run into difficulty. If we think about crypto now, with institutional input from the likes of BlackRock, etc., is going to be faced with the same challenges. So as I'm kind of relaying the story of what happened here, for those of you that may be investment companies, or for those of you working in venture capital firms looking for the next big ideas, look at the themes in equities and apply them going forward, because I think they're likely to repeat themselves. Okay, so 20 years ago, if you wanted to buy a share in an American company, wherever you were in the world, you went to the New York Stock Exchange. If you wanted to buy a share in a UK company, you went to the London Stock Exchange. And if you wanted to do the same in a European company, for example, in Germany, you would go to the Deutsche Börse. So these exchanges were largely controlled by governments and were highly profitable. In fact, at my time, one of the organizations I worked at, we conducted, we in fact hired a consultancy to figure out how much costs were going to these exchanges. So I was with Goldman back then, and we were paying a lot of money to transact with the London Stock Exchange, and we wanted to know just how big is that cost. And it turns out that the revenue per head of a London Stock Exchange employee 20 years ago was higher than the revenue per head of a Goldman Sachs employee, indicating that it was a highly effective, very rich business. And of course, banks didn't like the fact that their profits were going into exchanges that were supposed to be a utility. And so disruption started. Okay? And what happened, again, focusing on the UK market here, is the London Stock Exchange, which had enjoyed all this volume, suddenly found itself in competition. So Turquoise was created. This was a pan-European exchange of 15 investment banks all getting together saying, why should we give our business to the London Stock Exchange? Let's build our own exchange. So Turquoise appeared. Then the Americans, Bats Trading from Kansas, they wanted a piece of the action in Europe, so they set up Bats Trading, another stock exchange in Europe. And then Chi-X came along. Chi-X was an independent, venture-backed technology company that also built a pan-European exchange. So suddenly you had a situation where if you wanted to trade British Telecom Group, a big UK company, and you had, for example, 100,000 shares, you could not buy all of those shares on one venue anymore, because British Telecom shares, as the slide shows, 20,000 may be trading on Turquoise, 30,000 may be trading on Chi-X, 10,000 on London Stock Exchange, and then 5,000 on Bats. And if you had a very large order and you needed to fill that order, to do that, you needed to go to every single venue. So that's a problem, because a trader using his hands cannot physically open 4 different terminals and trade at the same time. So something evolved called smart order routers. And for those of you interested in technology, particularly in the quant field, this is the highest tech part of capital markets in equities. So if you go into Goldman Sachs or UBS, or any other big bank today, and you go into the technology department, the people building the smart order routers, or SORs as they're called, are the smartest, highest paid technologists in the bank. And it's the job of the smart order routers to, almost in real time, piece together all this liquidity. I'll give you an example of how that works. So Goldman built a SOR, UBS built a SOR. And then because Goldman was saying, well, I now need to buy 100,000 shares from my client, and I've got to go to 4 different venues, I may as well see if I've got some internal liquidity. And so dark pools evolved. That's off-exchange orders in equities that are owned by the banks. So I'm going to give an example here, and I hope the screen is clear enough. But in this example, and it's to underscore the importance of technology, because imagine, without this capability, without the ability to build these solutions, there was no way that capital markets could be disrupted. But in this example here, I want to buy 10,000 shares of BT Group. Okay, it's not a real-life example in terms of markets, but this is exactly what happens right now in capital markets in the B2B space. So I want to buy 10,000 shares of BT Group. I have a few choices. The first one is I can go straight to the London Stock Exchange, and I can purchase here 200 shares at a price of 117.25, because that's the best price. I need 10,000 shares, but I've got 200 shares here from the London Stock Exchange. I can then purchase another 1,000 shares at a slightly worse price of 117.26. And then finally, I can purchase the shares, another 8,800 shares, to make up my 10,000 shares. And I'm delivering to that client 10,000 shares at a price of 11,727. Okay? And that's because I've gone to the London Stock Exchange and purchased all my shares. The second scenario is that I can go to another exchange. And I can go to Chi-X, I can buy 10 shares at the top of the order book there for 117.25. And then I can buy 9,900 at the second level in the order book for 117.26, giving me a price 1177.25. Is that a better or a worse price? And then finally, the other alternative I have, if I'm using a very high-tech broker and I'm using leading-edge smart order routing technology, take Goldman Sachs, for example. I can get some of that liquidity inside my own bank. So I'm going to get 9,600 shares inside my own bank, not on the stock exchanges, but from my own internal liquidity. 2 more minutes. I can then pick up another 200 shares from the London Stock Exchange at the top of order book, the best price, and then finally I can do that from Turquoise. And so in this case, you can see I've simplified this, but the smart order routing technology has gone out and found me better priced shares by going to many venues. And so my average price is 11,725. So of those 3 scenarios, Scenario 1, Scenario 2, and Scenario 3, it's the third scenario that gives best execution. And why is that relevant? Well, on 11,000 shares, it makes no difference whatsoever, because the difference is perhaps hundreds. But when you are a pension fund, or you're BlackRock, or you're the Norwegian Petroleum Fund, or wherever you may be, and you're always executing in billions, or at least millions of shares, the difference here for a pension fund is huge. So I've got 2 minutes left just to finally recap on that. If there's a takeaway from this, it's to think about what's going to happen in the crypto markets now, okay? We have massive institutional inflows coming into crypto as of the last 2 weeks. Something like, I think, 6 or 7 billion traded in Bitcoin after notification of BlackRock's ETFs. We're going to get a lot of incoming liquidity coming into the equity markets, but there is not enough supply. So if you go to one exchange to buy crypto, you're going to be faced with the same situation that Equities was in 20 years ago. So if you're looking for companies to invest in, think about aggregators, crypto smart order routers, because they're coming next. So I gave you a very simplified example here where I want to buy 10,000 shares, and to do it efficiently, effectively, and to follow regulatory standards, you need to go to a host of different liquidity sources and piece that liquidity together. Now, we have one of our chief quants, Daniel, sat in the audience, who'll be embarrassed here, but he understands how complex this stuff is because he does it in FX. So when you think about the very simple example I gave you there, I was giving you an example with 4 exchanges where we're buying 1 share. In reality, this takes place every day with thousands of stocks all across the world, in Asia, in the US, and obviously in Europe as well. It's not just one client buying and one client selling, it's millions of clients transacting all the time. I gave an example of 4 venues, 4 exchanges. In reality, in the real markets today, there are hundreds. And I gave you some examples of what dark trading is, and there's hundreds of dark trading venues. So that very simplified version of technology is magnified 1,000 times to create modern-day capital markets. And without technology, without its ability to interact in the way it is, we would not have capital markets that are efficient today. So that's my speech. I hope those of you that stuck with it enjoyed it. Obviously, I'm not going to take questions now because it's lunchtime, but I'm going to be around on the Exness booth. As I said, we're getting into the B2B business. We want to dominate there, and Peter Plesser is your man to go to. Thank you, everyone.